It is hard to believe that 1 year has already passed since the first lockdown measures were put in place. However, with vaccinations on the way, it seems that there is finally light at the end of the tunnel. With the hope for a return to normality, interest rates have started to rise significantly since the start of the year. This has put pressure on equity valuations in certain sectors. Rising rates have led to an acceleration of the rotation from expensive growth stocks to relatively cheaper value stocks that will particularly benefit from the economic recovery. Although rising interest rates have created a lot of uncertainty in some sectors, they are above all a positive signal for the economic upswing. Even in Europe, we should be looking forward to the moment when rates will no longer be negative, which I believe will be a good thing. Financial markets remain in a dilemma facing two opposing forces. On the one hand, the expectation of a strong economic growth and massive fiscal stimulus, and on the other hand, rising inflation expectations and higher interest rates. This is likely to lead to a period of higher volatility and ongoing rotation in coming months. As long as interest rates are going up for the right reasons, namely the economic recovery, the positive effect from rising corporate earnings should more than offset the negative effect on valuations. In our asset allocation, we therefore remain overweight in equities with a focus on cyclical sectors and regions such as Europe. Europe has lost positive momentum recently, but the cyclical orientation of the economy speaks for the region. In terms of vaccination progress, Europe is lagging behind the US by a couple of months and the recovery will be delayed. But the trend is positive and governments are determined to boost nominal growth. We have taken some profits in emerging markets. The region has performed very strongly at the start of the year and will likely be more volatile in an environment of a stronger US dollar and rising interest rates going forward. Due to the rising trend in interest rates, we remain strongly underweight in government bonds. An improved growth environment and rising inflation rates should weigh on the segment. The underweight in investment-grade bonds, whose spreads have fallen considerably recently, remains in place too. We prefer high-yield bonds, which on a relative basis should benefit particularly from stronger economic growth. We also remain overweight in emerging market bonds. The risk premium provides a buffer and the asset class has been resilient in such an environment in the past. Overall, we stick to our current investment policy, being overweight in risky assets and underweight in safe haven bonds. We consider rising rates as a positive signal, which confirms the pro-cyclical positioning in our investment portfolios.